Hello, everybody. This is Alan Elman, the Blue Collar Investor, with today's option selling question of the day, which I've titled Hitting a Double and Selling the Stock Using the Trade Management Calculator. Today's question comes from Stephen. Alan, what is the best way to enter the series of trades attached into the Trade Management Calculator where I hit a double and sold the shares on expiration Friday? How do I account for the final option buyback, and which exit strategy should I select? Thanks, and it's signed, Stephen. Okay, I love members who take advantage of our exit strategy opportunities, and Stephen certainly has done that. Okay, I'm now showing a screenshot of the attachment that Stephen sent to me when he asked this question. Let's review the trades. On 4/22/24, 300 shares of XLE, which is a select sector SPIDA for energy, was purchased at 96.19. So now Stephen was in a covered or protected position. He was then free to sell the covered call option. So he sold 3 contracts of the 5/17/2024, so less than a month out, 93 in the money call, lower than the 96.19 purchase price, and that was sold at 425. So when we put it into the trade management calculator, the spreadsheet will deduct the intrinsic value component, 319, from the 425 to get our actual initial time value return. What happens? 5/1/24, there was a share price decline of XLE, and the 93 calls were bought back at 85 cents. You'll notice that 85 cents is approximately 20% of the 425. So the 20% guideline was initiated. Good for Stephen. Now, Stephen simply owned the shares without any option component or obligation. Well, look what happened, folks. 2 days later, the price went up again, and he resold the 93 call. Okay, that's what hitting a double is, at $1.58. So he started with a debit of 85 and then had a credit of $1.58 after the original 425 premium. So that was hitting a double. Buy back the short call and then resell it later in the same contract. Now, here we go. Expiration Friday, 5/17. Stephen closed the 93 calls at $2.09. Okay, the price of the security, XLE, at the time was 95.08, and those shares were sold. 300 shares were sold prior to 4 p.m. Eastern Time on expiration Friday. Okay, what I'd like to do next is show you a chart, a price chart of XLE, which describes the steps of these trades. So let's look over here at number 1. That's where the shares were originally purchased, and the original covered call was then sold. Number 2, you could see the dramatic share price decline where the 20% guideline was initiated, and there was a buy to close of the 3 contracts. Well, what happened? 2 days later, boom, price goes back up. Not all the way, but back up so that 3 contracts could be sold. That was the hitting a double aspect. You'll always notice that when you hit a double, there's a classic V-shaped pattern that you'll notice on your chart. Okay. Now, if you go all the way to the right of the screenshot now, you could see the fact that XLE went back up in price, and at number 4, he closed the 93 calls and sold the shares. And that represents all the steps of the attachment that was sent to me by Stephen, and so you can graphically see how the trade was executed. Very nice work, Stephen. Okay, now let's get to work with the trade management calculator. What I did was, instead of left to right where you can't see everything on the same screenshot, I piggybacked 4 sections of the Trade Management Calculator spreadsheet so you could see it all in one screenshot. Now, on the top section, you could see the trade was entered. XLE purchased at 96.19, 93 in the money call, sold at 425. Now, if we go to the second section from the top, you'll notice that the calculations are done. First, it identifies that if taken through expiration, it's a 26-day trade. The spreadsheet will deduct the intrinsic value, leaving $1.06 of time value, and that represents 1.14%. And based on the 26-day trade, that annualizes out to 16%. That's the starting point. Now, because it was an in-the-money strike, we also have downside protection of 3.32%, which means that we're guaranteed a 1.14% 26-day return as long as XLE doesn't decline by more than 3.32% by expiration Friday. That's very different than the break-even price point, which in this case is 91.94. Okay, now let's get into the hitting a double aspect. We buy to close at the 20% guideline, 85 cents, right? And we then sell the shares at 95.08. So we buy to close at 85 cents, and then we enter the option premium because we then bought back the option, and then that left us a debit of 51 cents. So that's incorporated into the spreadsheet, a debit of 51 cents. We sell the shares at 95.08. Where do we stand? Well, on the option side, we have an option return of 3%. We have a share loss because the shares were purchased at a higher price than they were sold for, of 1.15%. Net, we have a credit of 1.885%, which based on a 26-day return annualizes out to almost 26%. So think about this now. We bought a stock that went down in value, and yet we ended up with a realized final result of 1.85% 26-day return, 25.97% annualized. That shows you the power of covered call writing and implementing exit strategies along with our trades. Very nice work, Stephen. So let's summarize now. When we use the hitting a double exit strategy and then deciding to buy back the in-the-money strikes prior to expiration to then sell the shares, we can incorporate that cost to close with the second option premium. And this will result in accurate calculations. The BCI Trade Management Calculator will facilitate all of these transactions. It is an amazing tool that is a must for anybody selling covered calls or writing cash secured puts. Now, the reason why these trades were successful despite share value going down was A, Stephen used an in-the-money strike. He took a defensive posture, which turned out to be the proper one. And he also implemented the hitting a double exit strategy. So Stephen was prepared and took advantage of those opportunities. I'm going to briefly mention to you that to master these strategies of covered call writing and selling cash secured puts, go to our website, thebluecollarinvestor.com, over here, and click on the store, and then you could have our best packages. The BCI package is our main package. Our trade management calculator system package. You saw the TMC in action in this video. It also comes with my 8th book, which is 27 chapters of exit strategy information. And the third of our best package is our CEO package, which is an acronym for combining exchange traded funds with stock options. It's a quicker, more user-friendly, more time-efficient way to use covered call writing. And there's a screenshot of my 9th book, which comes with the package, Covered Call Writing, a Streamlined Approach, in addition to the 2 spreadsheets we created. Okay, so just go to our store, which will bring you down to 2 links. Best Packages is the one you should check on to get videos of those packages, or you can build your own toolkit and get items individually, you'll come to this link if you click on Get Your Own Toolkit. And folks, that ends this Ask Alan video number 226, hitting a double and selling the stock using the Trade Management Calculator. Stephen, thank you so much for this question and allowing me to share this information with the entire BCI community. And thanks to all of you who took the time to listen to and watch this Ask Alan video. I hope you enjoyed it. And most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.